All right, good evening, everyone, and welcome to our class today. Um, Personally, I actually didn't think that groups would be part of your assessment three until when I had to go look at it again. I realized, oh my God, groups is actually part of assessment three. Ah, interesting. Okay, so one thing about groups, guys, it's quite interesting. Groups is not new. Uh, we have done groups in second year. So I also understand that some of you guys did second year a long time ago. Others were doing others are doing a bridging course and all of that. So I understand that you may have forgotten how groups works, but for most, you have done it in second year, so it's not a new topic. And secondly, groups has quite a lot. It has quite a lot in. It's quite a long topic, if you have to put it like that. It's quite a long topic, and it's a highly integrated topic, so it keeps on building up. And then, when you eventually have to answer on a question in groups, then you have to integrate all the knowledge that you've actually learned so far. So, like I said, just realizing that groups is part of your assessment three, I decided to also do, okay, let me just do groups today so that when I meet you guys for a longer class on Thursday and on Saturday, we are then going to do like a question that will cover all the other topics. Okay. So again, I decided to attack on the question, like I said in the beginning, because groups is not new to most of us. It's not new. In fact, it's not supposed to be new. All right. So we will sort of revise the memory from what we did in second year and also introduce you to third year. So I've decided to attack the question because of the timing. Ne? But I don't leave you guys like that. I will send you guys pre-recorded sessions where I'm actually explaining groups. Alternatively, I've done groups on my YouTube channel as well. You're also welcome to check out my YouTube channel, Accounting with Naomi. I think I did about 2 or 3 videos covering groups name, explaining in detail. So you're also welcome to do that just to get more background on theory and the rest. Please feel free. I also have other recorded sessions I'll send to you guys when you get time, just for you guys to just make sure you get proper background. You are welcome to go and watch them. All right. But for the class, like I said, looking at the timing, we decided, okay, let's rather attack a question. So I'm teaching you both principle and how to apply at the same time. All right. And guys, yeah, all the best. I hope you are fine. I know you have been writing a lot, and I know a lot has been going on. There's been bill of tests, there's been assessment, there's been assignments. So I know how you are right now. Probably overwhelmed, probably stressed out, probably tired, and all of that, which is part of the package that you signed up for. But I just want to tell you guys, just remain calm through it. Remember the reason why you started, and it is important, what you're doing. So it's worth the sacrifice. Okay, it's worth the sacrifice. So let's get into our groups for today. I will share the question. After class, I will share the question. Since I didn't share it before, I'll share the question after class. So guys, I am sitting here with a question. I've got 3 companies. Okay. I've got Mosaic Limited, I've got Garnet Limited, and I've got Violet Limited. All right. Like I said, guys, groups is a huge topic, a very huge one. So when I just realized that it is actually part of assessment three, that's when I was like, whoa, what? Like, yeah, because it is a huge topic. But the good thing is we are not new to it, so we can build on it easily. So on this question, if I go to the required section, on this question, it says prepare. Just a minute, guys. My laptop is a little bit slow. I think I've been working too hard on it. Just a minute. I'm not able to function it now. Everything has just stopped. Okay. Uh, let's see. Yeah, hey, I'm so impatient with technology, IT, and all of these things. Okay, it's back now. Right. So it says prepare only. So they only want you to prepare like only one section, right? Prepare only the asset section, including deferred tax assets of the consolidated statement of financial position of Mosaic Limited Group as at 28 February 2017. All right. Then this is going to be 30 marks. So this is a 30-mark question. Only one question being 30 marks. Why is this so? Because like I said, it is highly integrated. Guys, groups is highly, highly integrated. That's why you get like a 30 marks question. You get like a 40 mark question. It could be one question for 40 marks because he knows there's a lot of things that they are touching on within that 40 marks. Okay. So within the statement, there's a whole lot of things that are being touched on. And then when you look at B, it says calculate the amount that will be disclosed as the non-controlling interest in the consolidated statement of financial position of Mosaic Limited Group as at 28 February 2017. So the first one, you're preparing a statement, consolidated statement. The second question, you're actually calculating. Now, you're not limited on what method you use when it comes to calculation. Okay, like I've always said, guys, there are those specific calculations we have. For example, calculation on deferred tax. We know we have specific formats for doing that, but most times when it is a calculation, you're not you're not close to a method. You are free to apply whatever method you want to apply, as long as it's clear and we can see what you're putting in and we can see how the calculation is actually developing. That is important, right? So the second one is a calculation. It's up to you how you wish to do this. For me, I would rather do an analysis of owner's equity because I'm going to use it anyways. Guys, I want to advise you. Please do your analysis of owner's equity. I understand there may not be time in the exam, but I'm advising you, especially in this level, to do, once there's groups in a question, do the analysis. Okay. Do this. So find a way to have speed on your analysis. Because once you move without it, you realize later that you need it, and it may be too late. When you realize that you need it, you may not have enough time anymore. So from the beginning, once you see group, put whatever they're asking you for, go and start your calculation on your calculation page. Start your analysis, because analysis actually brings everything together and makes you also not to miss out important information and not to miss out important figures. Okay, so for B, I'm going to use the analysis of owner's equity. Then he says, your answer must comply with the requirement of international financial reporting standards. All amounts must be rounded off to nearest rand. So we don't want any decimals like that. Just round off everything to nearest rand. Comparative figures and notes to consolidated financial statement are not required. So we don't want any comparative figures. Don't give us last year compared to this year. Just focus on the current year. Right. And of course, we also don't want notes. So basically, that's the question. So it's A and B. You see, it's two questions, but it's going to take us some time. So guys, for those of you who just joined, I did say that I'm going to take a little bit longer than 7. I believe so. First of all, I started late. I apologize for that. Secondly, I just want to finish this question so that we don't fall behind on our program. Because on Thursday, I want to see you for a revision question. I want to see you for on a question that covers a lot of topics. Like, yeah, more of an exam type of question. That's what I want to do on Thursday. So I don't want this question to follow us through on Thursday. Okay, so if you can stay longer than 7, please do, so we can finish this today. All right, so let's look at it. So once I'm doing a group's question, guys, I first read the required. After reading the required, I make the formats of what has been required. All right, so I'm going to go to the top. So we start there. I'm going to have I'm told to do a consolidated statement of financial position, and I'm told that the group name is Mosaic Limited Group. So once I get that, I'm going to come here and put Mosaic Limited Group. All right, so what do I want to do? Consolidated. Please don't leave the word consolidated, otherwise it changes the meaning of what it is. Remember, you're not doing individual financial statement, you're doing a consolidated, which means you're bringing in different companies together. Okay, so we want consolidated statement of financial position, and we want this as at, so I'm going to go down, as at 28 February 2017. Okay, now I can move aside. Okay, 28 February 2017. All right, so that's what I want to do. I know that my financial statements Okay. Then I'm going to leave my space. I know that I'm going to need a lot of space. I'm going to need a lot of space. So I'm going to just put my space. Remember, this is a 30-mark question. I'm going to put my spaces in there. All right. Then I'm just going to leave it for now. And then I'm going to go to B. B, I was told to In B, I was told to calculate the amount that will be disclosed as a non-controlling interest in the consolidated statement of financial position. Right. Another thing that I've also saw that on your guides is that they are only testing, basically they're not testing changes in ownership. So I'm not going to do change in ownership. We're only going to do change in ownership after after the assessment, so that at least we'll have our time, to sit on it like properly. We'll have time to sit on it properly. Okay. Let's just continue. So here I'm told to do a calculation of non-controlling interest. Non-controlling interest, and I said I'm going to do the analysis of owner's equity in here. So I have my analysis of owner's equity. I'm going to fill this up once we have done our group structure. Okay, so now that I know that, this is what I'm going to be answering. Basically, I do the consolidated financial statement, and I'm going to do the analysis of owner's equity to look for my NCI, non-controlling interest figure. All right, so when I come to my consolidated statement of financial position, I am told focus only on the asset section. Focus only on the asset section. So I'm going to come here and put on my assets. So I'll start off by writing, okay, I'm going to do assets. And then I know that my assets is going to be divided into two. So I'm going to have non-current assets. And I'm going to have current assets. So I'm going to leave some space and then have my current assets in here. Let me not use caps. Okay. Then now we are under groups, so we're looking at all the items that could affect my non-current assets and all the items that could affect my assets. Okay, so first thing first, we're going to look at this here. If you read here, guys, on the information that's given, before I read the addition, I just want to read background information. It says Mosaic Limited, so that's the parent's company. I think I pressed something wrong. Just a minute. Okay, are we fine now? Okay. Right, it says Mosaic Limited Group, which is the parent company, is a company that manufactures mosaic furnitures and invest in other similar entities in South Africa. All companies in the Mosaic Limited Group have a 28 February year end. The following information was provided by the management of Mosaic Limited Group. This is the extract from the trial balances of the entities in the Mosaic Limited Group for the year ended 28 February 2017. So I've got Mosaic, I've got Garnet, and I've got Violet. So there are three companies, right? Now, since I don't know who these companies are to Mosaic, I'm going to just focus on the actual accounts, right? So what do I have? I've got share capital, which is not an asset, it's an equity. I've got return earning, it's an equity. I've got accumulated depreciation, property, plant, and equipment. This is a negative asset, right? Then I've got trade, okay, trade and other payables. This is a liability. Then I've got profit after tax. Then I've got property, plant, and equipment. So this is my first non-current assets item. All right. Then I've got investment in equity. So I need to know, what are these investments? Are these simple investments? Is this a subsidiary? Is this a joint venture? Is this a joint operation? Is this an associate? So at this point in time, I don't know what are these investments. I can't just put them in there. Okay, so I see investments in garnet, violet, ruby, amethyst, aquarum, right? Then I see trade receivables. I see cash and cash equivalent. I see, so these are my current assets. I see trade receivables, cash and cash equivalent, and inventory. So these are my current assets. So let's start from the top. So before reading the information and understanding the investments, the forms of investment that I have, I can tell that I've got my property, plant, and equipment. So I've got PPE, property, plants, and equipment. Okay, that I know for sure, all right, that I have. Then I am told that I'm going to have a deferred tax. Now, deferred tax could either be an asset, could be a liability. We don't think a lot when it comes to groups in terms of deferred tax. It's all about the effects, usually the opposite effect. So I'm going to put my deferred tax here. I'm told to also account for my deferred tax. So do an asset section including deferred tax. So I know I'm going to have deferred tax, right? I know that there's another possibility that I'm going to have that I should know, guys. These are the items you should be looking out for. Another possibility is that I saw a lot of investment. I will have investments in financial instruments, all right? Investment in financial instruments. I may have it because I saw a lot of investment there. So I'm going to come here and write investments in financial instruments. Okay, like your IFRS 9 investments or your simple investments. I know there's a possibility of that, so I'm going to write it there. I also know that I may also calculate a goodwill. So I may also have a goodwill because remember we have groups. So there's another possibility. Guys, this is a possibility. It may even be a gain on bargain purchase or it can be a goodwill, but there's a possibility. So I know that it's a possibility. I'll put it there. See, I'm using different colors because these items that I'm putting in there are not part of the trial balance that we just looked at. The only item we saw on the trial balance is the property, plant, and equipment. But they know that in groups, there's a possibility that I may have a goodwill. Deferred tax, I am told that I should include deferred tax in my assets. And I saw a lot of investment, so there's a possibility that I'm also going to have investment in financial instruments or simple investments. All right, another possibility is that if I do happen to have joint venture or associates, then I may also have that. So I want to use a different color. So I may also have investments in either joint venture or associates. That is if I have possibilities. All right. These are my possibilities under my non-current assets. Now, if it happens that I don't have, I'm just going to put a dash. Okay. So, guys, that's what you do in the exam or assessment or written assessment or test. Whenever you're doing groups, guys, all your possible accounts, you put them down. You put all your possible accounts down. And if they happen not to be there, then they're not there. Simple. And then you just move on. Then you focus on those that are there. But it's at least it saves you time to do this. Okay. Then when I go to current assets, when it comes to groups does not really have a lot of adjustments when it comes to current assets. Most of the adjustments sit on non-current assets. But anyways, you see that as we go down. So we noticed some of the things when we're going down our trial balance. So we had trade receivables. So I'm going to come here. I'm putting this in black because I'm receiving this directly from my trial balance. So I have trade receivables. I have cash and cash equivalents. I have inventory. Okay, so this is basically all that I have. Like I said, we don't really have a lot of items when it comes to current assets, but we have more items when it comes to non-current assets. Okay, so at this point in time, basically this is my main main answer, if I have to say my main question. Sorry, this is my main question, and then the rest are this one is just a calculation. So this is my main question. So now that I'm there, another thing is I cannot put in any value if I do not understand what forms of investment do I have in this business? So once I have, first of all, given them the format of what they was required and given possible accounts that I know that may be affected, and then the next thing to do after this, the next thing to do is now to get the group structure. What is my group structure? So I'm going to come on the side. This will be my calculations. I'll put my group structure under my calculations. If you don't get the group structure in groups, you cannot move. Unless if it's a simple group like we did in your second year. Second year, we only had one parent and one subsidiary. In third year, we can have multiple subsidiary and a parent. We may have other forms of investment like associates. We can have joint ventures. We can have joint operations, right? So there are multiple forms of investment that we can have that can be part of the group. So I have to get my group structure. I also need to know, is it an horizontal group or is it a vertical group? Right. So we do understand that they're no longer testing vertical groups. It's only horizontal group that we have to worry about. But then again, I need to know my group structure and my forms of investments. All right. So in my group, I do understand that the very first company is usually your parent company. The very first company is usually your first parent company. Again, even if I don't pick up that, I understand I've been told that my group is Mosaic Limited Group. So the company that carries the group name is the parent company. That would be the toppest parent. If I was doing a vertical group, it would be the parent at the top. All right. So Mosaic Limited is the parent. So that's where my group structure will start. So I'm going to have Mosaic Limited, all right, at the top. Then I need to now link them to other investments. So I have Garnet, I have Violet. What is the relationship with Mosaic? So I go down my additional information and I look out for the information. So we're going to read now. Starting from number 1, it says on 1 January 2014, guys, date is important, very important. That would be my acquisition date, right? So on 1 January 2014, Mosaic Limited acquired control. Now, you only get control when you are a parent, and this is a subsidiary. So you only have control over a subsidiary. Okay. So Mosaic Limited acquired control over Garnet Limited by purchasing 160,000 of its issued ordinary shares for an amount of 280,000 when the returned earnings of Garnet Limited was 140. So I'm going to pause there. First of all, what happened? We have purchased control, all right? Obtaining control makes us a parent and makes them the subsidiary. So in other words, Garnet Limited is a subsidiary. So I'm going to link my group like this. Starting with Garnet Limited. So Mosaic Limited purchased on the 1st of January 2014. Just to double check that. Yes, 1st January 2014, they purchased 160,000 shares. Okay, issued shares in Garnet Limited. So they purchased 160,000 shares over what was the total shares that Garnet actually issued. Okay, so I'm going to go back and check out the total issued shares from Garnet Limited. Just a minute, my laptop is being a little bit slow. Okay, right. So I'm coming here. I'm looking under the shares. I want the shares. How many shares did Garnet Limited issue? So I'll check here where it is share capital. Under share capital, that's where I'm going to check. And then, so the first company is Mosaic. The second one will be Garnet. So this is how much shares there was in issue for Garnet Limited. This is the number of share. And when you come across here, this is the actual value of the share. So the number of share is 200,000. So I'm going to go down and put this over 200,000. I want to calculate what is the percentage that they actually purchased. They didn't tell us the percentage. They just told us how many shares they purchased. So if I take the number of shares over the total shares that is in issue, so these are my shares, then I multiply this by 100, I will be able to get the percentage. How much interest do they actually have in the company? Okay. And somebody please calculate for us.
80%.
80%.
80%. Thank you. Oh, I don't know. I think my kids lost my calculator. This is gonna be tough for me now. Oh, Jesus Christ. Okay, guys, just a minute. Just a minute, guys. Okay, guys. So 80%. Right. So you can see that actually what a relationship that Mosaic Limited and Garnet Limited is of control. So therefore, Garnet Limited is actually a subsidiary company. So Garnet Limited is a subsidiary company, right? And if the relationship between parent and subsidiary means that we are actually going to consolidate 100%. So with subsidiary, we actually consolidate 100%. Consolidate 100% of the figure is actually going to be consolidated. Okay, then the next one now. So I'm now looking at the next investment. One, two still speaks to one, so I'm gonna skip that one. I want the one that talks about violet, so that will be three, information three. I'm still gonna come back to all of these. I'm just trying to get my group structure first before I move on. Okay, so if you go to number three, it says on 1 March 2016, Mosaic Limited acquired 49% interest in Violet Limited. In terms of the contractual agreements between the other operators, Mosaic Limited exercises joint control over the economic activities of Violet Limited. The arrangement is classified as a joint venture as per IFRS 11 joint arrangement. At acquisition date, the fair value of the identifiable assets and liability of Violet Limited were considered to be equal to the carrying amount hereof. Okay, now let's get this one. Now I have Violet, so I'm not gonna link Violet. So this is on 1 March 2016. All right, so we have now purchased 49% in Violet Limited. This one have been told how many interest I have, so it's 49% interest, and I'm told this is a joint venture. So I have a joint venture, and guys, we do know that with joint venture we are going to apply what is called the equity method. So here we are going to apply a equity method, right? So here we focus on the equity, and then we increase basically increase the investment with the adjustment in equity, and then we are going to create two major accounts with this one. Actually, there are three, but most of the time we use the two. So we are going to have number one, share of profits in joint venture, which is going to be in my statement of profit and loss. So in statement of profit and loss, we're not going to have items like revenue, cost of sales, other income. We're not going to have that. All of that is going to be bring down. Actually, you find a total. All income and expenses are in this line item. The total will be the share of profit in joint venture. This is if I was doing a statement of profit and loss, which we are not doing in this question, right? Now, another account is the investments. All right, so investments in joint venture. This is the one that affects the statement of financial position. So you're not going to account for the item one by one. You're going to have this one where we're going to just calculate one line item that has all the items that affects my, assets and liabilities, basically all assets and liability. Let me edit here. So the first one, it's all income minus expenses. Okay. Then here it's all assets minus liabilities or all equity. Okay, so basically that's what's happening here. And then the third one would be if I have other comprehensive income, then I'll have share of profit in other comprehensive income, right? Which we don't really use unless if there is other comprehensive income. Let me just put it there because we are making notes anyways. The third one would be if I have other comprehensive income, there is going to be share of other comprehensive income, share of profit Yeah. Other, where's that comprehensive income joint venture? Or is it off? I think it's off, not in. Okay. Right. So these are the three accounts that are affected under the equity method. So when you're consolidating, you are not going to consolidate 100% of the figures like you're going to do with subsidiary. Here, you are only going to create this line item. So you take nothing. You take nothing, you create one account. In my statement of financial position that I'm busy with right now, I'm only taking these. This is the only one that is going to be affected. It's going to be one line item. You take nothing, only one line item, which you're going to basically calculate and bring in your statement of financial position. So with us knowing the group now, so I can conclude that I actually have horizontal group. This is an horizontal group. Like I said, they're only going to test the horizontal group. They're no longer testing vertical group. It's been like, I think, 2 years now. Was it not 3? I think 3. Yeah, it's now been 3 years now. They have not been testing vertical groups. So it's only horizontal group. This is the only type of group that you're actually going to be examined on or tested on. Yeah, so just get used to this one. Okay, so let's get going. Now that we have this information, which is very, very critical. If I don't have this information, I'm not going to be able to consolidate. Remember, consolidation has 3 procedures, right? 3 steps. So first of all, I'm going to add like items. Number 2, I'm going to eliminate common item. Number 3, I'm going to eliminate intragroup transactions, right? So before I get to intragroup transactions, I have to first of all add like items, right? So for me to do that, I need to understand the forms of investment I have. Like in this case, I have subsidiary, I've got a joint venture and a parent, right? And I understand that with subsidiary, I'm going to obviously consolidate 100% of the figure. But with joint venture, I'm only going to account for, like I'll bring everything into one line item. Okay, so let's now go. With that information being said, I can now do my first step, which is to add like items. Right. Sometimes they'll refer to that as step 3, but likewise, it's still the same, okay? You are adding items that are the same. All right. So, property, plant, and equipment, that's where I'm starting. Now, guys, please take note of this. PPE is always accounted for at carrying amounts. So, we have a problem here. I'm being given PPE at cost. So, that cannot be right. So, I now need to go and look out for my accumulated depreciation, so that I can take my cost minus accumulated depreciation to give me the carrying amount. Please check this. Your PPE should always be at carrying amount. Right. So now that I've picked that up, I'm going to now bring my figure. So we're taking 100% from the parent, 100% from the subsidiary, nothing from joint venture. If we had an associate, we also take nothing. Please take note that equity method is applied on joint venture, also on associate. The same, exactly the same. Okay. So 100% from parent, 100% from subsidiary. Let's start with PPE. So PPE at cost, I'm taking 100%, which is 533,600. So I'll come here and put 533,600. Right, plus I took the amount as is 100%. Then I'll take also the subsidiary for Garnet. I'm also taking 100%, which is 948,560. Okay, now remember this is given at cost. I actually want this at carrying amount. So I'm gonna take their accumulated depreciation, but I'm minusing, remember, cost minus accumulated depreciation for me to get my carrying amount. So I'm going to come here. My accumulated depreciation for parent, I'm taking 100% of the figure, 150, and the subsidiary as well, 280. So I'm going to come here, put minus 150,000 minus 280. Let me just put it here, 280,000. Okay, so these are easy marks, guys, easy mark. But if you make one mistake, you lose all the marks. Eh? It has to be 100% correct when you are getting these easy marks where you are adding like items. Guys, you get just one mistake, you lose all the marks. Ne? All right. So goodwill, we know that it's going to come as a result of acquisition. So we look at that later. Deferred tax will come as a result of adjustments. Okay, when we have adjustments, intra-group transactions, then it comes to affect deferred tax. Investment in financial instruments, we're still gonna get there. Now that we're actually gonna get there now, let's go look at it. So this is what's happening here. Garnet. So we say what we're gonna have. Step 2 is what? Eliminate common items, right? So all investments, the investments within the group and the equity within the group will actually be eliminated. So in other words, Garnet is within the group, so Garnet is going to be eliminated. Violet is within the group, Violet is going to be eliminated. At acquisition, so at acquisition, I'm going to eliminate the investments as well as their equity for the parties within the group. So what am I left with? 3 other companies. So I have 3 other investments that are not part of the group. They are not, by them not being part of the group, I mean, we don't have control over them. We don't have joint control over them. We don't have significant influence over them. That's what I mean. So if you don't have significant influence, control, or joint control, then it's not part of the group. It's just another simple investment. Okay. So there are 3 other companies. Now let's check who actually has investment in this company. This is a consolidated financial statement. So it's not a one company thing. It's all 3 bringing together, right? So let's check. The first one, so I have here with me Ruby. Guys, please use like a ruler or something. When it comes to groups, use a ruler. Otherwise, you may end up putting the wrong figure. Eh? So we have Ruby. Ruby, the investment is from Moisec. So Moisec is the one that has 100,000 in Ruby Limited. This is a simple investment because not part of the group. There's no joint control. There's no control. There's no significant influence. So this is a simple investment. That's my first one. Second one, I have Amethyst. So I'm going to go across Amethyst. Amethyst is an investment obtained by Garnet. Garnet is my subsidiary. We did say that with subsidiary, we take 100% figure. So I'm also taking that as my number 3. The last one I have is Aquamarine. Aquamarine. Aquamarine is being obtained by our associate company. Now, remember the rule. We don't take anything. So we're not going to take this figure. We don't take anything from the associates. With associates, we deal with the share, investment in joint venture. Did I say associate? Actually, it's in joint venture, guys. It's not an associate, it's in joint venture. Let me just fix that. All right. The treatment is the same, but remember, do not call it associate if it's not an associate. That will still make it wrong, although you will treat them exactly the same. Okay. So that's my joint venture. So we're not going to take this Aquamarine investment because it's coming from the joint venture. The joint venture is the one that has these investments. So we're not taking it. Okay. We're not taking Garnet. We're not taking Violet because Garnet is a subsidiary. Violet is a joint venture. So both of them are going to be eliminated at acquisition. Ruby, we are taking it. It's another simple investment obtained by the current company. Amethyst, we are taking it because it's a simple investment obtained by Garnet Limited. And then Aquamarine, we're not taking it because it's obtained by the joint venture. All right. So how do I know that it's a simple investment? If it was something of importance, like something that there's control or joint control or significant influence, then they would have noted that underneath, or it would have been part of the items on the group. All right. So if it's not part of the items in the group, then it's another simple investment. Okay. So when I come here, investments in financial instrument, or you can say equity instrument. Actually, equity instrument is the proper word. In equity instruments, financial instrument is too broad. So we lay it down by saying equity instruments. Okay, so I have here my first one is the Ruby, the one for Ruby Limited, which is 100,000. Plus the next equity instruments, investment in equity instruments I have is Amethyst, which is 25,000. So I'm going to come here and add the 25,000. Okay. Then investment in joint venture. In this case, it's not an associate. We know exactly what it is. So I'm going to remove the associate part and just leave the joint venture because we know it is investment in joint venture. Or we can just write it in full. Instead of writing JV, don't get used to writing, abbreviating things because you end up doing that in the exam. Okay, so these ones still need to be calculated. So I can now skip to the other items. let me get my easy marks. Like I say, you make one mistake, you lose all the easy marks, right? Again, same principle. We are combining items. Take 100% from parent, take 100% from subsidiary. Oh, please take notes, guys. They are also not examining joint operations. Joint operations are no longer examined. I think it's also been like, I think 3 or 4 years that they have not examined joint operations. So it's only joint venture, associates, and subsidiary that are going to be examined. Okay. Right. So then we have trade receivables. So trade receivables, we go here. Parent, I take 100%, so 115,000. Subsidiary, I take 100%, so 45,000. Then cash and cash equivalents. Parent, I take 100%, 78,000. And then subsidiary, I also take 100%, 85,000. Then we have inventory. Inventory, also take 100%, 180 from parents, and 100% from subsidiary, 87,000. You take nothing for joint venture or associate. Nothing. All right, so at this point in time, these are the easy marks. What I did is just to combine like items or accounts. Right, I've just combined. That was my first step. The next step is now to look out for intra-group transaction. The next step is to eliminate common item, which we're going to do that at acquisition. For me to do that, I have to do my analysis of owner's equity. I don't have to, but it's a good method that you do the analysis of owner's equity. Okay, Oriental, that is actually as per principle. Okay, as per principle, when combining like items for a subsidiary, you take 100% because of control that you have. Okay, the control gives you that right to actually combine 100% figure. All right, but when it comes to sharing, like we do when you do the analysis of owner's equity, when you have to share our portion, we don't take the 100%. But for the assets and of course the liabilities, we take 100%. We account for the 100%. But when it comes to sharing items like profit and the rest, we only use our our percentage, our interest. Okay, so that's the principle. Perfect. Right, so we've got this part, and you see, guys, I've left my brackets open. All my brackets are open, like I said, because I'm still going to eliminate common items. I'm still going to eliminate intra-group transactions. All right. So at this point in time, I'm going to leave this for now, and then I'm going to go finish off my analysis. Now, we are actually killing two birds with one stone, because I'm answering B at the same time I'm also doing my analysis, because I was going to do it anyways, whether the question was for me to calculate non-controlling interest or not. I was still going to do my analysis of owner's equity, and I'm advising you to do so. I'm really advising you to do so. If there's a group's question, the question on groups, just do the analysis of owner's equity in peace. In fact, do it and then answer. Because I'm telling you, if you try to run away from it, it may catch up with you. So it also depends on how good you are. You don't have to. If you are very good, you know your groups like in and out. If you're a guru, and then I will not advise you. But I'm advising people who are just getting to understand, or are not very sure. They think they know, or they're just trying, they are trying to master. If you are in that group, in that WhatsApp group, please do your analysis of owner's equity. Ne? It's going to save you a lot of problems. Right. So we have analysis of owner's equity in Garnet. Garnet is my subsidiary. So I'm doing my analysis for the subsidiary company. That's the biggest one. I can still do the analysis for the joint venture, but I'll do that later. Okay. So let's start with this one. This is usually my biggest one. Like I said, we're killing two birds with one stone, answering B at the same time, also doing our calculation. Right, so we have here, I'm going to have my non-controlling interest. Now, remember, if the company owns most of the shares and the other shares that are remaining belongs to the other owners put together. So let's say we have 5 shareholders and you already have like 55%. of shares. Then the other 45% that remains to the other 4, all of those put together are non-controlling interest owners. So when we're doing the analysis, we're trying to find out how, or we're trying to say, is this investment worth it? Is it worth it? How much are you actually receiving from this investment, and how much goes to the other owners that don't have controlling interest? All right. How much belongs to them? So at the end, we have our non-controlling interest. Then, of course, we're going to have a section of the parents. Then we're going to have the total, because we are doing the analysis on the subsidiary company. Right. So I'm going to have that. Now we have 3 stages. All right. I'm going to show you guys the timeline just now so it can make sense of what I'm saying. So we're going to have the at acquisition stage. We have the since acquisition, of course, and the current year. So since is after, ne? At acquisition and since after the acquisition. Then we have the total column. Then, of course, here the parents is Mosaic Limited. So at this point, I'm not going to show how many percentage control do they have. So the total percentage will be 100%. We understand that Mosaic only has 80% in this business. Then the other 20% belongs to all other owners put together. They don't have control. Those are my NCIs. All right. Now, before I go any further, you need to understand where the accusation, since, and the rest of them come from. So I'm going to do a timeline. Remember, in accounting, we always do timelines, always. So my timeline, my year, the current year I'm working with, ends on the 28th of February 2017, meaning that the year started on 1 March 2016, right? So this is referred to as my current year. This is referred to as my current year. This is actually my stage number 3. So I've got 3 stages. The stage number 3 is my current year. Then I'm going to have the at acquisition date, which is the date that Mosaic Limited actually obtained control on Garnet. So if I come back to my group structure, which I've already laid everything there, there's my date. So it was actually acquired on 1 January 2014. So I'll just put 2014 somewhere here. 1 January 2014. The day, on this day, exactly on this day, is my at acquisition date. So that's my at acquisition, meaning on this particular day, we could start with consolidation, right? On this particular day, the business, there was a business combination, actually. The group was formed on this particular day. They obtain control on this particular day. So that's the day. That's the at acquisition date. This is my period, or rather stage 1. Okay. Then in between, after this date, all the way to the beginning of the current financial period where we are right now, this is referred to as since acquisition. Right. This is referred to as my stage number 2. Now, understanding these stages are very, very important so that you know how they play a role in consolidation. So we started off by showing you how I'm consolidating, but how does these stages play a role? Now, at acquisition dates, so this is the date that you're saying, okay, fine, you have now become a parent of this company, so you're now controlling this company. So at this stage, I want to know, was the investment worth it? Like, is what I've invested, is it equal to the equity I'm actually receiving? Is it higher than the equity I'm receiving? Is it lower than the equity I'm receiving? And then I need to, at this stage, the controlling company, the parent company, needs to actually revalue all the assets and all the liability of the subsidiary on this day. They will revalue and then see if they need to make any adjustment. The adjustment is going to be made. And then we're going to calculate the total equity. How much equity is this investment worth? Is this subsidiary worth? So once we find that, then I need to know, okay, I'm not owing 100%. So I'm not a wholly owned parent. It's not a wholly owned subsidiary. So I'm not owing 100%. It means there'll be other owners. That is where we split your percentage versus the non-controlling interest percentage. From the total equity, we then share it to say, okay, fine, for my investment, I'm only going to receive 80% of this. Then I then compare this with how much I'm paying. to say, okay, was this investment actually worth it? Was it worth it? Did I make a right decision by investing here? All right. So if we're saying that the investment is equal, if the investment is exactly equal to the equity, then there's no problem, right? So it's like we purchase at net assets. If the investment is actually bigger than the equity, that's when we obtain goodwill. So we have this non-current asset. Now we have goodwill because the investment that the money that we actually put in is actually bigger than what we are receiving. And if the investment amount is lower than the actual equity, that's when we have excess, right? Or also referred to as gain on bargain purchase, which is an income now. So it's more like a profit. It's more like we bought this as a profit. Okay, so at the end of the day, it's a win-win. Whether you bought it at a higher amount, you're still winning because now you have a non-current asset. If you bought it at a lower amount, you're still winning because you've made a profit from it. So it's a win-win situation. You never lose, right? That's what we want to do at acquisition. I want to just check, is this investment worth it? Then since acquisition, I just want to know what were the movements after now. Okay, fine. Now that we're going ahead with this acquisition, after the acquisition and before we get to the current year, what happened in between? What are my movements in equity? How did my equity improve? Has it gone up? Has it gone down? That's all I'm doing at since acquisition. Then in the current year, I'm checking now the profit. Is this company operating well? Did it make a profit? Did it make a loss? How much of the profit belongs to me and how much belongs to the NCI? And of course, you also account for the dividend. If the dividend was paid, because remember, guys, dividend is paid from profit. So if dividend was paid, we have to we have to deduct dividend from the profit so that we know exactly, of course, how much is actually going to the parent and how much is going to the NCI. And then don't forget, at all these stages, there are going to be intra-group transactions, which needs to be adjusted. All right, so we'll look at it as we go. Intra-group transaction. Guys, I know I promised you guys classes. I'm going to send you quite a number of classes that details some of these things, where I just explained principle. Okay, I'm going to send you guys so that we are not falling behind. So for those of you who needs further understanding or needs like to understand the principle, then you have time to actually just, just listen to where I'm just dealing with principle. But like I said, guys, groups is highly integrated and groups needs more application than any other thing. So it's not enough to hear it, you must do it. Actually, teaching it like this is best for groups because what I'm saying, you must see me do it for it to make sense. I don't know. But yeah, I would send you guys extra classes just, to get the principle solid. Anyways, so these are the 3 stages and those are what actually happens on those stages. Okay. And that is why it's important. That's how it gets actually combined into the consolidation process. So now let's apply. Now that I know I've got all 3 stages, so I'm going to come and start at acquisition. This is my first stage at acquisition, right? So I want to check how much equity does Garnet actually have, right? So my equity items, all right, the main two which are always there will be my share capital and my returned earnings. These two will always be there. Now, other times you may have market to market reserve, you may have revaluation surplus. All right, those will be the other equity that you may have. Okay, and if there's also changes in equity, you will have change in equity. Sorry, changes in ownership. You have change in ownership reserve, which is basically calculated later. We'll talk about that when we do change in ownership. For now, let's just focus on our analysis. Okay. So these two are always there. So I can write this without even looking if they're there or not because they're always there. Anyways, so I'm going to go up. My focus is on Garnet, the subsidiary. Remember, I'm analyzing their books to know if I made a good decision by investing or not. Okay. So my focus right now is only on Garnet, nothing else but Garnet. So my focus is here. So we want share capital in rand values, not the number of shares, in rand values. So if you check now in rand values, the share capital is actually 200,000 for Garnet. So I'm going to come here and put 200,000. Then we have retained earnings. So retained earnings, guys, Please take note. At acquisition date. At acquisition date. Not at the beginning of this year, not at any other date. They can give you different return earnings with different dates. The one you want is at acquisition date. So if I go back to my timeline, my acquisition date is what? 1st January 2014. That's the return earnings I'm looking for. Nothing but this date. In case I'm not given, if I'm given any other date, I have to work back to the acquisition date to get the return earning at that date. Please, I hope it makes sense, né? I hope it makes sense, guys. If you are given maybe at the beginning of the year, it means now I must work back. I must work back. How much was the actual return earnings at the date that we actually obtained control? Okay, so let's look for that. I'm going back to information 1. If you go back to information 1, it says what? On 1 January 2014, Moisec Limited acquired control over Garnet by purchasing 160,000 of the issued ordinary shares of Garnet for 280. That's my investment amount. Then it says when the retained earnings of Garnet Limited amounted to 140. This is the retained earnings on this date. That's the one I'm interested in. So in 2014, 1st January, my retained earnings was 140. So I'll come here and put my 140. Okay, so far these are my equities that I have. Unless if there's others, if I check down my trial balance, after return earnings, I'm seeing accumulated depreciation, trade, blah, 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 blah. I do not see any other items of equity, right? So then I'm going to go down and continue to read in case there was adjustments at acquisition. Remember, whatever I'm doing right now must be limited to the period that I'm under. I'm currently under the at acquisition, and only the items that affect current at acquisition should actually be looked at. No other item. So I looked at number 1. I'm going to look at number 2. Number 2 says, it says at acquisition date, the fair value of the identifiable assets and liability of Garnet Limited were considered to be equal to the carrying amount thereof, except for land, which was valued by 10,000 more than its carrying amount, and inventory, which was written down by 9,000 to its net realizable value. So what just happened here? Let's even explain this. Let's break it down. So what happened? We said you as the investor, you have to now revalue all the assets and liability of your investee, right? So in this case, Garnet Limited. So we are going to revalue all the assets and liability to check the price in the markets and compare. So they said after you have done that, the fair values, all the fair values of all the assets and liability were just the same as what they had in their books. Okay, so we checked on the markets. Every other thing is still the same. My PPE value, carrying amount, is still the same as the price in the market. So we're fine with that. Then we came across 2 discrepancies. So we had the land. We saw that, oh no, land is actually it's actually more, the fair value of land is actually more than the carrying amount by 10,000. Then we checked inventory as well. Inventory, we actually saw that, no, it's actually less by 9,000 because the net realizable value is actually written down by 9,000. Okay, so that is what happened. So there were 2 accounts, so 2 adjustments that needs to be made. We're going to have an adjustment on land and we're going to have adjustment on inventory. Now, please take notes. While I'm still at acquisition, if the adjustment is on property, plants, and equipment, no, not property, non-current, sorry guys, is on non-current. Yes, PP is just an example. Let's use non-current rather. If it's on non-current assets, if the adjustment is on non-current assets, we are going to account for this in this consolidated statement of financial position. All right, we will account for it. But if the adjustment is on the current assets or liability, we are not going to adjust the statement of financial position. Do not adjust statements of financial position. Guys, I hope you're making notes, Nick. What I'm saying right now is very, very important. And groups is highly integrated. You just have to remember this while you are busy in the question. All right. It's not like it's gonna sit somewhere. Somebody's going to ask you for it. You will have to apply it. You're gonna simply apply it. Okay. So you're not going to add to your statement of financial position. This is adjusted in retained earnings. To be adjusted in retained earnings. This is to be adjusted in retained earnings. Okay. So please remember that. So whatever it is, whether it is adjustments in trade payables or trade receivables or inventory or whatever, just know that as long as it's a current asset, we are going to simply adjust this in retained earnings. We are not going to adjust financial statement. But if this affects any of the non-current assets, we are going to take that adjustment and put it also in the statement of financial position, consolidated statement of financial position. Please take note of that. So let's go and deal with this. And oh, don't forget tax. This is where it differs with second year. In second year, when you do any of these adjustments, you do not actually include tax effect. But when it comes to third year, everything you do right now will have a tax effect. So there'll be a tax effect. Ever since we met deferred tax, it's going to follow us all the way. Okay. So let's go and adjust this. So I'm going to adjust these are our adjustments. In other words, this is going to increase the land. The actual asset is going to increase by this, but it is a revaluation surplus. Okay. And then the other one, it's more like a loss on inventory written down. This one is inventory written down. It is a loss aspect. So it's not the actual inventory itself, it's the loss aspect. Just like the other one is the revaluation surplus. All right, but of course it also does affect the asset because non-current. Anyways, let's go here. So I want to make my adjustments and I'll do them like this. So I'll have revaluation surplus. I have a surplus because the item value went up by fair value. This surplus is on land. All right. And then the value actually is given. So it's 10,000. I don't need to calculate again. This is given as 10,000. Do not forget its tax effects. The tax effect on this is that we're going to take the 10,000. Now remember, guys, land is realized through sale. I think we've been talking about this for a while. So it's not new to any of us. We've been talking about this for a while. It is realized through sale, meaning this affects capital gain. I think for a while now we've been touching on that. So it means I'm taking this multiplying by 80% first because of the inclusion rate. Capital gain inclusion. This is a C. Inclusion rate is 80%. Okay, so I first multiply by 80%, then I multiply by the tax rate. So guys, this is a long-term question. So the tax rate here was still 28%. I'm just going to use the one that was. But remember, in your paper, it's going to be 27, eh? Okay, right. I'll use the one that the question gives us. All the time when you're doing a question, just apply the one that the question gives you. So there we are. We are calculating the tax effect. I applied 80% on this one because I'm dealing with land. Land is realized through sale. Every other item is going to be just multiplied by 20%. All right, so let's calculate. Let's calculate, guys. How much will be the tax effect?
2,240.
2,240. Okay, so the tax is always going to be the opposite direction. So tax will always just do the opposite. So if this is adding, the tax is going to minus. Deferred tax with groups, now you don't have to worry so much. Just do the opposite. Let's do the opposite. Okay, perfect. So now we have that. That is on land. Now let's look at the inventory. So we're gonna have inventory written down. Inventory written down. So this is more like a loss. They also give us the figure. It is a negative already. It's 9,000. All right. Then we don't have to forget the tax effect. Let me just confirm the figure. 9,000. Yes, that's correct. Do not forget the tax effect. This one is realized through use. So I'm used to just multiply by 28%. So I have my tax effect. 9,000 times 28%. Let's calculate.
2,520.
2,520. Opposite, ne? So this is minus, the text will be positive. That's all you're doing with text, guys. Text, you don't have to worry. When it comes to group, you don't have to worry. So these are the items that I could see that affect me at acquisition date. After that, if you go to number 3, it's already taking me to violet. So it means we at acquisition date, that is it. That is all that happened at acquisition date. There's nothing else. So I'm now going to find my total. I'm now going to find my total. Let's calculate the total. Please, let's many people calculate so that we get the correct figure. We compare. How much are we getting?
I'm getting 341,280.
341,280. Are we confirming, guys? Are we confirming?
Yes, getting the same amount.
Perfect, perfect. Okay, so now that we have the total, so this is how much Garnet actually have in total. But this is my total column, it's my 100% column. So Moisek Limited purchased 80%. So of course their share of this will be 80%. Okay, so we're gonna multiply 80% of that, of the total. How much are we getting? Of the total, only the total, ne? Multiplied by 80%, how much are we getting?
273,024.
273 and 24. Okay,
24.
perfect. So guys, why didn't I do one by one? This is another way for me to save time in the exam. It's not necessary for me to say share capital times 80% of 20, return earnings times 80% of 20, revaluation. You don't have, it's not necessary. All those figures are not necessary. I'm only interested in the total. So this will help me save time. That's why people don't finish the paper, because they are putting energy on unnecessary things. Okay. Do not apportion one by one, apportion the total only. Okay. There will be time where you need to do that when you're doing joint venture analysis and joint venture or associates. Later on, when you actually need to show all the items, then you do one by one. But in the situation of subsidiary, just deal with the total. So this is how much I have. Let's also calculate the NCI portion and check where I'm writing, guys. I'm writing under the at column. The sys column is still empty because I haven't reached there yet. I'm still under the at column. Okay. Let's also calculate the NCI portion. How much is the NCI portion? The 20%. How much is the 20%?
68,256.
68,256. Perfect. Perfect. Okay. So now that we are here, we now want to get now here. You guys pay attention. This is where we now determine how well the investment is. Okay. So I'm going to start with the parents. We'll deal with them separately. The parents separately, NCI separately. So let's start with the parents. How much did I pay for the investment? Okay. So I'm going to go here. I want the actual amount that I've paid. Now, remember, you can pay with assets as well. you can pay with shares as well. Okay, so you can either pay with cash, with shares, with assets. Okay, you are allowed to. If you are paying with assets, you're going to measure it at fair value. Please write it down somewhere. If you are paying with assets, you will measure it at fair value. So you check the fair value amount. So some questions you see that they've paid with assets and then they give you the cost or the carrying amount and then they give you the fair value. So they'll give you like 3 figures. They give you cost, they give you carrying amount, they give you fair value. If it's an asset, you will measure it at fair value. Okay. If it is cash, of course you use the cost price, the money that you paid, the cost, right? Then if it is shares, with shares they'll tell you how much is the price per share or the market price per share, whatever it is. When they'll give you the price per share, you would then use it to calculate how much is the share's value. All right, so you use the price per share. If it is asset, you use the fair value. If it is just money, you use the money that was paid, the actual money paid. All right, so in this case they only paid with money, with cash. They paid 280,000 for the investments. So that's the only thing they used. Okay, so if you come across a question that has both assets and money, so you're gonna check the asset at fair value, the money, the actual cost. If there's shares, you're gonna use the price per share to measure the share price. Okay, then you add all three together if you have all three. All right, in this case it's only 280, so I'm going to come here. So I'm skipping a line in between. Guys, forgive me, I was writing here, so let me just do something like this so it doesn't affect my I don't want to remove these things, so I'll continue underneath. Yes, guys, I didn't calculate my writing name. I'm so sorry for that. I hope it does not affect somebody. Okay, it's all good. Just want to make some border around this to say this is not part of this. This is not part of this. Anyways, let's continue here. So I skip a line for me to get my consideration paid and my NCI value. So the consideration paid was 280. This is how much they actually paid for this investment. Okay, and then from there I can calculate either a goodwill or a gain on bargain purchase. And if it's the same, then there's no goodwill, there's no gain on bargain purchase. So if you look at what we have right in front of us, the investment is worth 273,024, but I paid 280,000. So I've paid more than what I'm actually receiving. Meaning, remember, it's a win-win. Whether you pay more, you pay less, you're still winning. So because I've paid more, it means that this is going to create a goodwill. So I'm going to have an asset now, an added asset on my side. All right, the investor. So we're going to have goodwill, which is going to be the difference between 280, which is the investment amount, and 273, which is the equity obtained for 80% shares, right? So 280,000, let's calculate, guys, minus 273,024. How much does this give us? How much is my goodwill?
6,100.
So my goodwill will be 6,976. Okay, so this is Eddie. This is the value that goes to my non-current assets in the statement of financial position. That's the amount that goes there. Now, then remember I said we look at it differently, separately. We look at the parent separately and the NCI as well. So the NCI may also have goodwill. So how do I know if they have goodwill or not? So we have to check which method is being applied. All right, so there are two methods. Let me use green. So you see, even though I'm doing a question, I am teaching a lot of principles. If you really are paying attention, I'm teaching a lot of principles, right? So there are two methods here for us to determine the goodwill, right? Now, method number one, if the company uses the partial goodwill method, or they say the NCI is measured at proportionate share, In this situation, if this is the method that is being applied, it means there will be no goodwill. No goodwill or excess or gain on bargain purchase. So I'm not going to have that if this is the method that you apply. Now, I'm not the one who decides that. The scenario, the question that is given to you will decide which method they are using. So you are just going to apply whichever method that is being said you are going to use. Okay. So that's the first method. In this situation, remember, if I'm measuring a proportionate share, this is the proportionate share. This is my proportionate share. So there's no need. It means that my total will also be exactly the proportionate share. Okay. Right. Then method number 2. This is if they use the full goodwill method. Also, guys, this method was not examined in second year. And this is only examined in third year. So those of you that did groups last year, you would see that there was no full, we did not apply the full goodwill method. Maybe you were just told, but it was not examined. But now in third year, we use both partial and full goodwill method. Goodwill method. Or they will mention that NCI was measured at fair value. NCI measured at NCI measured at fair value. Okay, so if my NCI is measured at fair value, this means that my total is going to be different from the proportionate share, the actual share. And if I'm using the full goodwill method, then it means that I'm going to calculate. So either they said full goodwill method or they say measured at fair value, you are going to calculate your goodwill. So you're going to have a goodwill. Goodwill or gain on bargain purchase. Okay. So now that you know what entails this method, so we're going to go down and look for information that tells us which method is applied in this particular group. So we're going to go down. Usually I'll check it from down and start going up. So I'm going to go down. Okay, this one tells us about each share carries 1 vote. Fine. This one tells us about the tax rate and the capital gain. And then here it tells us about the market value of garnets on this date being this price per share. Then let's look at number 7. I think that was somewhere 7 is what we're looking for. So 7 says the Moisek Limited Group elected to measure their non-controlling, so they decided to measure their non-controlling interest at fair value at acquisition date. All right, so that one there's a full stop, and then it goes on to say goodwill was tested for impairment at year end. This is now year end. We're gonna deal with that one later. Okay, there was impairment of goodwill, but at end of the year, and it was determined that the goodwill relating to GAN was impaired by, this is for end of the year. But at acquisition, they decided that they will measure the NCI or non-controlling interest at fair value. In other words, we're applying the full goodwill method. Now, if the question is going to be measured at fair value, then how? If you go to 8, now it says the market value of Garnet at acquisition date was R1.75 per share. So that's what I'm going to use to calculate the actual fair value that you're talking about. Some questions may give you the fair value. In this one, we are calculating the fair value of the NCI. All right, so I'm going to calculate the NCI fair value. Let me use green for that. So first of all, in issue in total, Garnet Limited has 200,000 shares in issue in total, multiplied by the NCI percentage is only 20% out of that 200, and the price per share was actually R1.75. R1.75. So from there, I'm able to calculate what would be the fair value, or what was the fair value at acquisition date. Let's calculate, guys. Let's calculate. Okay, so we're taking our 200,000 shares multiplied by 20%, multiplied by 1 rand, 75 cents. How much would that give us?
70,000.
70,000. Right, so I'm coming here and putting 70,000 as my fair value because we are measuring this at fair value. Okay, so now we can calculate our goodwill. As you can see, the fair value is bigger than the actual equity. So this is also going to give us a goodwill. How much would our goodwill be? Let's calculate. How much is our goodwill?
So 1,740.
1,700 and
44.
44. Perfect. Right, so then we can get our total goodwill because now I have this plus this to get my total. Let's add them. How much are we getting?
8,720.
8,720. Okay, then I can also calculate my total plus 341,280. And then my total there, I'm getting 350,000. Okay, so guys, that is it. This is what happens at acquisition. Remember, I don't need to do all these one items. I just needed this total price. This will tell me my goodwill, tell me everything that I actually need. Okay, so yes, that is at acquisition. Remember, we did stage 1. We're still gonna do stage 2 and stage 3, but a lot of work is actually done here. It's in here. At acquisition, I feel the rest, maybe other work will be when we have intergroup transactions, but most of the work is done here. So where I'm sitting right now, I can now adjust some of the things that affect my statement of financial position already. I can start doing my adjustments. Okay, so let's start. The first thing I want to do is the revaluation surplus on land. All right. So we have revaluation surplus. That means the land's value has gone up by 10,000. I'm going to go to statement of financial position. All my adjustments are going to be done in red. I'll do all my adjustments in red. So I'm going to go to my PPE that is already sitting there, and then I'm adding plus 10,000 Rand. This 10,000 Rand is from what? The revaluation surplus on land. Now remember, this also have a tax effect, right? So that tax effect is just going to be the opposite, guys. Remember, we keep saying that, né? The tax effect is going to be the opposite. The amount was 22,440. Because I added the asset there, I'm going to minus 2240. All right. The inventory, like I said somewhere there, I think I wrote the note somewhere there. This one is going to affect the return earnings on the next period. So we're not going to affect, it's not going to be adjusted on the statement of financial position because it's a current asset. Current asset is, you know, they are realized within a year, right? So that is why it's going to be adjusted on the returned earnings value and not in the statement of financial position. Right, that's the first thing. The second thing that I can put there is my goodwill. Goodwill, guys. So I have just created my goodwill. Guys, the goodwill, you take the total, the extra total goodwill. Total. And if I have more than one subsidiary, I'll take for all of them, all the subsidiaries. If I had like 3 subsidiaries, I'm going to go to subsidiary number 1, take the goodwill, subsidiary number 2, number 3. If they have goodwill, I'll take all 3. In this case, we have 1 subsidiary, so we're only taking the goodwill of that 1 subsidiary. Guys, you do not account for goodwill on joint venture or associate. There's no such. When applying equity method, the goodwill is already part of the carrying amount, so there's no need to account for it. We only account for goodwill of the subsidiary company. All subsidiaries that I have. I hope it's making sense. Okay. So I'm going to come to my goodwill. Goodwill, I was using green. So I'm going to come to my goodwill. I'm going to put my values. So they want the extra figures. So it was 6976 plus 1744 Okay, so that's my goodwill so far. Remember, it was impaired later, but let me rather leave it for later so that when we do the actual adjustments on the time that it happened, then we'll bring it here as well. Okay, so far from what we have done at acquisition, those are the adjustments that I could make. So I had an adjustment on PPE, I had an adjustment on goodwill, I had an adjustment on deferred tax. Okay. Then we can now move to the next stage. So we have ticked off at acquisition. Now I'm sitting at since acquisition. I'm now sitting on since acquisition, the next period. I'm going to put it here. So we are now on since acquisition. Okay, so in since acquisition, I want to basically look at those equity items that I had in the beginning, which had changes. Please take notes, guys, in this level. Okay, you will not have any adjustment on share capital. Share capital will just remain the same. All right, so don't expect any adjustment on share capital. It's going to remain the same. Otherwise, it's going to become very, very complex and complicated, right? So the items that you can have movements in is your return earnings, is your revaluation surplus. If there was a revaluation surplus in the beginning, all right, not this one that we have. This one was an adjustment. If I had a total column with revaluation surplus, then I will check if there was movement. Okay, I repeat, if you see this return earnings is coming from the balance that was given, if I had a balance of revaluation surplus, I will then check also if there's movement. The one we have here is just an adjustment. You're not going to use that one for movement. Okay, another one we can have is market to market reserve. If I also had a balance of market to market at acquisition, then I'll check for movement since acquisition. Okay. So basically, from what I'm looking at here, the only items that I can check movement for is return earnings. Because I said, guys, share capital does not have movement. They won't in this level, do that to you guys. So let's look at return earnings. Guys, from what I'm already doing in this one question, I'm sure you guys can pick up how much groups is. Like, it's a lot, all right? But once you understand it, you guys, you will enjoy it. Once you understand groups, you just want to do questions on groups, like you wouldn't want to do any other thing, just groups only. But then to get there, there's a lot of remember this, remember that's what I'm saying, guys. Make sure you're writing notes. Make sure you're writing notes, and make sure you go back to this question and practice it again. Once you master it, it's done. Groups is done, and groups is an opportunity to score high, guys. It's an opportunity to score, like score, because they don't really complicate. I don't really see a possibility of them complicating groups. It is either you know it or you don't. You know, if you know it, then you know it. If you don't, then you don't. But if you know it, they won't trick. They won't trick you. You know, that's how good groups is, right? They can just put a lot. It can be a lot in one question, but if you know, you know. They can't trick you. Anyways, so under return earnings, the first thing I want to look at is movements. So I'm gonna check the movements. So by movements, I'm gonna compare in the beginning of the current year. Remember, we are looking at this period. I mean, since acquisition, I'm looking at this period. After acquisition date, before the beginning of the current year. So I want to know the return earnings this date minus return earnings on this date. That will be where my movement is sitting. Okay, return earnings at the beginning of the year versus the one at acquisition. All right. So let's go back to the trial balance where we're going to get the information. So I want return earnings at the beginning of the year. Guys, you should know how to work, right? So you know that in my return earnings, it's opening balance plus profit minus dividends. then I get retained earnings at the end of the year. So that formula, I should be able to work backwards. Whatever I don't have, I should be able to work backwards to get it. Ne? So again, to get retained earnings, you have opening balance of retained earnings plus profit for the year minus dividends paid, then you get retained earnings at the end. You can use the same formula to work backwards. So in case I do not have the value of retained earnings at beginning of the year, but I'm only given at the end of the year, I should be able to work back. Or if I don't have it at acquisition and I have it at the beginning of the year, I should be able to work backwards using the same formula, right? But backwards. Anyways, it will make more sense the more you practice, the more questions you do on groups. And guys, groups, you have to do a lot of questions. You have to do a lot of questions. Please, at least do 3 or 4 before you write. And you have to do a lot, okay? Because there are a lot of things that we won't see here. You see, when I keep talking, I keep making reference to other things that are not in this question. So you will have to do another question, maybe that will have other things that we didn't cover. So at least 3 or 4 before you write, né? Okay, anyways, let's get back here. So we are looking for return earnings at the beginning of the year. If I check here, my return earnings is exactly at the beginning of the year. That's the one that is given to me on 1 March 2016. And my focus is still on Garnet because I'm doing analysis of owner's equity of Garnet Limited. So it's going to be 480,000. That is my return earnings at the beginning of the year. So 480,000. I'm going to go quickly here. Put my 480,000 or 80,000 minus at acquisition. The return earnings at acquisition was 140,000. So I'll check the movement if there was an increase or if there was a decrease. So from that date to this date, our return earning has actually increased. Now let's calculate the value. How much has it increased by? 480,000 minus 140,000. How much is that? How much is that?
$340,000.
340,000, that's correct. So 340,000 is my movement. Then after this, guys, I look for adjustments. These adjustments I'm looking for, these are intra-group transactions, and intra-group transactions are those transactions that are done within the group. Like, we're not allowed to sell to each other, we're not allowed to buy to each other and charge each other a profit. You know, we're not allowed to loan each other and charge each other interest, right? We're not allowed to give services to each other. So whatever transaction that happens within the group must be eliminated. Because it's like you're saying you're selling to yourself at a profit. You're providing a service for yourself. Why should you charge yourself for doing a service to yourself? Like, that's basically the idea. So any transaction that occurs to yourself, by yourself, should be eliminated. Okay. So let's go look out for that. Remember, we are also still working on the stages. All right. Whatever I'm doing is still within the stage. Right now, I'm sitting within the period of after the 1st of January 2014 up until before 1 March 2016. Anything after that, I'm not going to work on it. Okay. So we're going to go down and check more. I'm going to be ticking off the things I don't need anymore. I've already dealt with 1 and 2. 3, we're still going to do that because it's violet. And then 4, let's look at what's on 4. 4 says, during the current year, Mosaic Limited sold inventory of 100,000 to Violet. This is Violet. Violet is still the joint venture. I'm going to skip this. I only want transactions between parent and subsidiary because I'm doing the analysis of the subsidiary only. So that's the only thing I need right now. Okay, so I'm skipping 4 because 3 and 4 is for Violet. Let's go to 5. 5 says, on 1 December 2016, this is December. My year starts in 1 March. So December is during the year. Anyways, let's read further. On 1 December 2016, Mosaic Limited sold equipment with a carrying amount of 110,000 to Garnet. So you see it's Mosaic and Garnet for an amount of 125,000. On this date, the remaining useful life of the equipment was 3 years. The entity's policy is to provide for depreciation over its expected useful life of the equipment using the straight line method, which is in line with the allowance received from the South African Revenue Service. On the 28th February 2017, 40% of the selling price of the equipment was still outstanding and included in trade receivables and trade payables of Moisec Limited and Garnet, respectively. Guys, again, the period this falls in, this is in December 2016. And if I go back to my timeline, December 2016 will actually fall within the year, after, somewhere here, within the year. So this is not going to, this is not going to be during the since accusation. It's going to fall somewhere here, December 2016. All right. So it's during the year. So I'm going to look at this only during the year. It only affects us during the year. All right. So this is not since accusation. Then, so basically that will be that. And then 6 says Moisec Limited Group measures its investment in equity instrument at cost. This is per principle. It has to be measured at cost. So for those of you that are doing multiple choice questions, quiz, what, remember the investment must always be at cost, not at fair value. Okay. Then the rest of the information, I think we read it. So that's the only intergroup transaction we have, and that falls within the year. So let's close off. So we don't have any intergroup transaction that affects us at since acquisition. Then don't forget, remember we had inventory written down. It must be reversed on the next period. It has to be reversed. Remember, this one is realized within 12 months. So in the next period, it has to be reversed. This effect must be reversed. So I'm going to have, and this is applicable to current asset and to current liability. Ne? So I'm going to have inventory written down, right? It is now reversed. So I'm now adding, then the tax effect is now being minused. So we do the opposite, ne? Because I'm reversing this. So this is the only adjustment I have, which I had at acquisition. It just needed to be reversed. And then, so these are the only things that actually affect my returned earnings. So I put them in a box and I find the total returned earnings, which I will then share. All right. So I have 340,000 plus 9,000 minus 2,520. How much are we getting, guys? Please, let's be a little bit fast. How much are we getting?
Um, 346,480.
346,480. Okay, perfect. Then we are going to now share this between the parent and the NCI. So we're going to calculate 80%. I'm going to calculate 20% of that. How much is my 80%?
277,184.
Okay, 277,184. Okay, let's calculate the NCI portion as well.
69,000.
Sorry?
69,296.
69,296. Is that correct?
Yes.
Okay. Perfect. So now that we have now shared the retained earnings, and then we are done in the since acquisition period. This one, we just wanted to know what are the movement that happened and if there's any intergroup transaction within that. So we have passed our first stage, we've passed the second stage, and then the current year. This part does not affect the statement of financial position at the asset level. This does not affect the asset level, but this would have affected equity, né? Especially when you do statement of changes in equity, this part would have affected that, but not the assets. So there's no need for us to take this in our asset section that we're busy with. Right, then let's go to the current year. I'm going to just do this underneath here. We are now looking at the current year to finish off. Right, so in the current year, what we want is first of all, in the current year, we want the profits for the year. We want profit for the year. In this question, they actually give it to us. Other questions, they'll give you items where you have to calculate. They'll probably give you revenue, cost of sales, other income, other expenses. You're going to just take revenue minus cost of sales plus either income minus other expenses minus income tax, just like that to get the figure. Because the amounts are actually correct. You just have to find the profit. In this situation, it has been given. So I'll just take the given profits. All right. And it has to be profit after tax, guys, not before. Profit after tax. So we go to our trial balance to get that profits figure. Sitting in here, there's a profit after tax. I'm still busy with Garnet, so my focus is on Garnet. Right, so 214,560. 214,560 is my given profit. 214,560. Okay, then I'm going to do my adjustments. Right, the first one, let's deal with the goodwill impairment, right? So there was impairment on goodwill, payment on goodwill. Okay, I'll start with that one before we look at the other intergroup transactions. This is in number 7. So okay, let me just tick off all these things because we've dealt with them already, and now we're dealing with number 7 also. You can just tick it off as well. So it was impaired by 2,000. All right, so that means it went down by 2,000. Impairment loss, remember, it is an expense. So it went down by 2,000 rand. I'm going to start with that one and then decrease my profit accordingly. Now, before I go on, let me even pause here. There's another note you need to write down. The only time you're actually going to share the goodwill impairment between the parent and the NCR is if they have used the full goodwill method. In this situation, in the situation where we're using the full goodwill method, that's the only time that we actually also share the impairment. So we share the parent between the parent and the NCR if goodwill method was applied. That means the NCR also had a goodwill. That is why we're sharing the impairments. If they use the proportionate share of partial goodwill method, that means we're not going to share with them. So you're not going to minus the goodwill from the profit here. You do it outside your analysis. You're not going to minus it from the profit, and you're not going to share it between parent and NCI. Let me repeat. In the situation where the partial goodwill method was applied, what we're about to do, you will not do so. You will not decrease your profits by the goodwill impairment, and you're not going to share the impairments between the parent and the subsidiary. Okay. The reason why we are doing this is because we have applied the full goodwill method. Okay, but anyways, like I said, we just have to do more questions. The more questions you do, the more you'll see most of these things I'm talking about, and to make more sense as we go. Anyways, let us continue. So that was the first adjustments. The second one, it's what we looked at. We said we'll come back to it. Now you have to take note of this. I'm going to make some notes, guys. Write some notes as I'm going to explain what's going to happen here. So it's always important to know who sold to who. Who is making the profit? All right. So it says here on December, Moisec Limited sold. Very important. So we have here Moisec. Moisec is who? The parent. Moisec sold to Garnet. Garnet is who? My subsidiary. So in this situation, the company that sells is the company that makes the profit. The company selling is the company making the profit. Okay, this person will get the item. In this case, I think is equipment, if I'm not mistaken. Right? This is going to change a lot of things. This is very important. What I just showed you guys now is very important. Now, before you jump on to show this in your analysis, and if you don't do this, you will do the wrong thing. The only time I'm going to adjust my analysis of owner's equity is when the subsidiary company is the one making the profit. In fact, when the subsidiary company is the one selling, that's the only time that you're actually going to show this adjustment in your analysis of owner's equity. So in our situation right now, it is not the subsidiary that is selling, it is the parent that is selling, it's the parent making the profit. So yes, this intergroup transaction must be eliminated, but it will not be included in the analysis of owner's equity. I repeat, the only time that you will actually adjust the intergroup transactions in the analysis of owner's equity is if the subsidiary company was the one who sold the item and or who is making the profit. If it is the parent, do not include this in the analysis of owner's equity. You can still account for it in your statement of financial position or statement of profit and loss, but do not include in the analysis if it's not the subsidiary who is selling. I hope we are clear. Is there anybody who is confused by what I just said? Please write notes. Please write notes. Is there anybody who's confused by what I just said now?
No.
All right. Okay. I'm going to continue. And like I said, guys, most of these things will make sense when you practice. This one is a practice. You cannot run away from this. If you don't practice groups, you can't. Like you can't. Hey, yeah. If you don't practice, I don't know how I'll help you there. So you have to practice for you to master. And I'm telling you guys, once you know groups will become your favorite topic. It will become your favorite topic. It's either you know or you don't know it. But when you know it, oh my God. Oh my God. It's one of the best topics. Ne? And the good thing about groups is that it gives you maximum marks. In the test or exam or whatever, it has a lot of marks. And if you understand it, they can't really trick you. So there's a high chance of you doing very well. At least there's like an 80% of you, 80% chance of you doing well. Like you have an 80% chance to pass it. So if it's out of 100, you have like 80%. That is if you understand. You have like 80%. So even in another good thing is that they love to test groups. Groups is highly examined. It means even in your final exam, where you have like over 15 topics, you are sure that there's going to be something on groups. That one is without negotiation. There's definitely going to be groups on the final assessment that you're going to do. So it means I must know it for now, I must know it for later. And if I know it, I have a high chance of passing because there's a lot of marks coming from groups. Do you understand? So it's just one topic that you don't play with. Just take your time, master it, and make sure, because this can help you pass the final exam. It can help you pass FAC3764. Yes, that's what I'm trying to say. You can actually pass the FAC3764 because your final assessment, you can hit it very hard because of groups. So it is one topic that one must take seriously. Like seriously. I don't know how many times to emphasize that. One must really take groups seriously. Okay. Anyways, let's go back to our intra-group transactions. So we understand that it's the parent that is selling, it is not the subsidiary. So this does not go anywhere close to my analysis of owner's equity, but that does not mean it's not an intra-group transaction. It's still an intra-group transaction. So I'm still going to deal with the intra-group transaction itself. So what happened? Let me go back to it. So on this date in December, we sold an equipment. The parent sold an equipment to the subsidiary. So both of them are part of the group. They're not allowed to sell to each other, especially not at a profit. So that profit section must be eliminated. We must also reverse the depreciation that was on it, as well as the tax effect on it, and. Right. So this is a depreciable asset. So I'm gonna eliminate the unrealized profits. I'm also gonna eliminate the depreciation and reverse the tax. Okay. So let's do this. Step 1, eliminates. I'm just trying to squash everything here, please, because of space. So eliminate unrealized profits. So it's not the full amount that you're eliminating, it's only the profit amount. Eliminate unrealized profits. Number 2, reverse depreciation on profits, on unrealized profits. So they'll tell you this one has now been realized. And then 3, tax effects on both, né? Okay, so first thing first, how much is my profit? So it says on 1 December, Mosaic Limited sold equipment with a carrying amount. So obviously this will be what it will be carried at. That will be the value that is being carried at, the carrying amount value. They sold it for 125. So that's the selling price, all right? So I'm going to say 125 minus 110. So it's going to be 125,000 minus 110,000. So this is going to be 15,000. Okay. That is my unrealized profit that must be eliminated. Of course, I have to calculate the tax effect on that. Let me rather do the tax just close to it. So I'm going to say 15,000. This is just an asset, a depreciable asset which is realized through use. So I multiply by 28% only. So I have 15,000 times 28%. I'm getting 4,200. Right, that's my tax. Then the depreciation on this, on the profit. So the profit is 15,000. Over, I must use the remaining useful life. That's what I'm using. Remaining useful life, not the total. So sometimes they can play with you, give you both total and remaining, or they give you the total, then you have to calculate how much is remaining. So, or how much has been used, how much is remaining. So you have to do that work there. But what you need to know is that you are looking for, this is the one you want. If it's not given, calculate it. Okay. There is always information enough for you to be able to calculate this figure, right? So on this date, the remaining useful life of the equipment was 3 years. That's the one I'm going to use. So this over 3 years, it's a straight line method that I'm applying here. Over 3 years multiplied by. Now, remember the elimination is starting from the time it was sold until. When I eliminate my 15,000, I eliminate it once at December, right? At 1 December, I eliminate my 15,000. But depreciation is spread out for 3 years. So depreciation is being spread out. Because it's being spread out, I'm going to start from the time it was sold until the other 3, like the remaining 3 years. Okay. So for the current year, it was sold in December and our current year ends in February. So for the current year, unfortunately, I'm not going to do a full year. It's going to be apportioned. So it's going to be from December to February, meaning December, January, February, 3 months. Okay, December, January, and February. So it's only 3 months depreciation that falls within the current year. Now, I'll keep on doing this as we go. Next year, I'm going to eliminate another 12 months. And next year, I'm going to eliminate another 12. The other one, I'm going to eliminate another 9 months until the full 15,000 depreciation has also been basically reversed. Okay. So, we are saying 15,000 divide by 3, multiply by 3, divide by 12. So I'm getting for the current year 1,250. Then I'll calculate the tax effect, 1,250 multiplied by 28%. This is giving me 350,000. Okay, so yes, guys, I have gotten all my figures that I needed on this. Then there was another statement they made, which was the last statement. So they now said on the 28th February, still at year end, there's 40% of the selling price of the equipment was still outstanding. So they didn't pay the 40% of the 125. And then it was included in, for one company, it was included in trade receivable. For the other company, it was included in trade and other payables. This is another intragroup transaction, separate from the the equipment, selling of the equipment, right? So it's more like they're owing. We're not supposed to owe each other as well. So I have to actually go and remove this 40% that is sitting in trade receivable and remove it also in trade payable. But in this question, my question is only limiting me to assets. So I'm only going to remove this from trade receivables. Okay. So I'm just going to do the calculation. Oh, now I don't have space. Okay, it's fine. I'll do it later. I just need to remember. All right. So let me finish off my analysis. Then I'll deal with that one later. So in my analysis, I didn't have any other adjustments because remember, it was the parent who sold and not the subsidiary. Okay. So I'm just going to close off this to say this is the only item that actually affected my profit for the current year. And therefore, I'm saying 214,560 minus 2,000. I'm actually getting 560. 212,560, right? That's my profit. This figure can then be apportioned to say multiplied by 80%. I'm now under since acquisition, so this will go 170 and 48, and then the non-controlling interest portion of 60. This is going to be 442, 512. Right. Then don't forget, guys, don't forget the fact that we also have dividend. Dividend is not going to be on your face, but you have to remember there's a possibility of having dividend paid. Most times we pay dividend. If the company is doing well, if we have a profit, we're going to pay dividend. So most times there's going to be dividend. So always remember it. All right. So I'm going to go to my trial balance to see if there's a dividend paid somewhere. So dividend paid on Garnet was actually 50,000. So the Garnet Limited actually declared and paid dividend worth 50,000. This decreases my equity. Then I share that as well. 50,000 times 80%. Then times 20%. Okay, so guys, that is that. So I've done my at acquisition, I've done my since acquisition, I've just now done my current year. So you see, these three stages, they tie up, all right, on my analysis, and it helps me with my consolidation. All right, so it means it is done. Remember what we're doing, guys, with B with killing two birds with one stone, right? While I was busy with my analysis of owner's equity, I was also answering B, which says calculate the amount that will be disclosed as your non-controlling interest. So here I was calculating my total non-controlling interest that were to go to the statement of financial position. Consolidated statement of financial position. If I was doing the equity section, right, I was going to have this value. Now, this value is the exact same column. All I have to do is get the total. All right. So to get that, I'm just going to get my total. I'm taking 70,000. So 70,000, which is my total at acquisition, plus my total since acquisition, which is 69 to 960. Is it? No. Guys, please remind me what was this figure. I don't think it was this big. Oh, okay, I added a 0. There's no 0 here. So it should be 69296. Okay, that's my total at since acquisition. Then we're going to have the profit for the year. So plus 42,512. Then, so this is going to give me 18 blah 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 minus 10,000. Okay, how much are we getting? Because I'm seeing an amount here that is different from mine. Okay, so Renta, you fixed yours, ne? Right, so it's 171,808. That's what I'm getting. Okay. So once you have done that, that is our total. That is what they actually wanted in B. Now, remember, guys, this is what they asked you, ne? If I was to sit in the exam, I didn't have to do the full analysis, although it is important because I'll still need it for other things. So what am I going to do? I was simply going to just focus on the total column and the NCI to save me time. Whatever I'll do the total, I'll just calculate the NCI portion. Do the total, calculate the NCI portion. But it's still going to affect you because remember, you're still going to need your goodwill. You're still going to need this effect here, these effects, the surplus, the land, the you know, you're still going to need it. So in this case, really, there wasn't really a running away from this full analysis. It was going to affect you either ways. Okay. So where we are right now, remember, I'm not doing a statement of changes in equity. I was going to use my dividends, my profit, and statement of profit and loss. I was going to use my profit and a lot of things. So there isn't really much that I'll use on my statement of financial position except impairment on goodwill. That's the only thing that I'm actually adding now. Impairment on goodwill. So here we are done with B. We have found this is what they wanted in B. So we found what they wanted in B, and I can go and tick off. So this one is done. So we just need to finish off A. So far, what else we adding here is the goodwill impairments. So I'm gonna come here to my goodwill. Where's my goodwill now? Over there. I'm gonna minus 2,000. So with my goodwill story, we're actually done because nothing else can happen to goodwill apart from this impairment. We are done. Right. Then another thing that I had was this intergroup transaction, which does not affect the analysis, but it does affect our statement still. So let me go deal with this one. So what are we told? Eliminate unrealized profits. So what's going to happen here is that I am going to debit the profits. So in this case, it was going to be included in other income. So I was going to debit other income and I was going to credit the actual equipment itself. So if I'm crediting an asset, it means I'm decreasing it. So this means that this 15 is going to decrease my PPE. So I'm going to eliminate my 15,000 in my property, plants, and equipment. So I'm going to come here and eliminate this. Sorry, let me use red. I said all my adjustments are going to be done in red. Oh, I don't know what I've pressed now. I pressed something wrong. Yeah. Technology. Okay, there. Minus 15,000. Right, you need to also have reference name. Let's just say this was, so this one I'll reference, this one was coming from B. Let's just say this was calculation number, maybe number 1 or something. Or 2. Let me just use 2. You have to make reference. Now, I know I didn't really do reference like I'm supposed to, but please make reference. So, I'm minusing my PPE, the unrealized profits. Then the tax effect is the opposite. If I minus here, I must add here. All right. So my tax was 4,200. Then it's being added 4,200. Then there was also the depreciation, which is going to be added back. Remember, depreciation is being reversed. So the depreciation amount was 1,250. So I'm going to come here, add back 1,250. Then the tax is going to be opposite, so it's going to be minus. And my tax on this one was 350. So I'm going to minus 350, opposite. Ne? Right, so that is what happened at that intergroup transaction of the equipment, selling equipment. Then they didn't end there. There was also a portion that was still being owed. The 40% of 125 was still being owed, and it was included in trade receivables and in trade payables. So when you go to trade payables, we don't have trade payables in this question because you're dealing with assets only. So I go to receivables, I'm going to say minus. So it's 125,000 times 40%. That figure. Okay. So yeah, that's about it. I'm also eliminating that part. And with that being said, guys, every other thing has been touched except for violet. So every other thing is touched except for 4 and 5, which deals with violet. So right now, the only thing that is left is the investments in joint venture. This is the only thing that is left for us to finish off this question. That's the only thing left. Every other thing has been done, so I can even close off. But anyways, let me just finish before I close off, because maybe I can still have something that will affect what I have in here. Okay, I'm just gonna add this for total. Anyways, so the only thing left, I'm gonna just do quickly, guys. Give me just about 10 minutes or so, then we'll be done here. I just wanted to finish this question so that you guys will have time to also work through it before I meet you guys again on Thursday. At least you would have had time to work on it. Okay, so the only thing left right now is the investment in joint venture. Now there are different methods that you can use, but I will teach you first the analysis method. That's the one I think we are comfortable with, that we already know. Then I'll teach you the other method when I see you again on groups. Okay, right, so I'm gonna do analysis, but this time is on equity method. This will be my last. All right, so I'm doing analysis of owner's equity of violet, because I just want to get that carrying amount figure. All right, so the analysis is almost the same. There are a few differences, so I'm going to apply here that I'm applying equity method. I will show you guys the differences as we go when applying equity method. So with equity method, you're not going to show the NCI. You focus only on the company that you have invested in. You will not show any NCI. You're not interested in the NCI, only the company you're with. So instead of NCI, we're going to have carrying amount. Let me use a different color. So we're going to have the carrying amount, which is the column we are interested in. The extra column that we're going to get a total from, right? Then we are going to have the normal adds and sins total. Right, so I have my total column, which is my 100%. I have my adds, and I've got my sins acquisition. Then the parents, or rather the investor. This one is not a parent, it's an investor. The investor in Violet Limited is Mosaic Limited, and Mosaic only has 49%. So here we are not sharing any other thing. We are focusing on our 49%. Right, that's the difference number one. Then another thing is you need to take note also, when was this purchased? So if I go back to number 3, it says this was actually acquired on 1 March 2016. This is the beginning of the current year. So my at acquisition is exactly at the beginning of the current year. So I don't have a period in between. Remember this period I had in between, the at acquisition date and the beginning of the year? I don't have that period in between, because this situation, the actual investment was acquired right here. So this is basically my period number 1, and I'm already on my period number 2. So I only have 2 periods. I do not have the since acquisition in between at acquisition and the beginning of the year, right? So I only have 2 stages that are affected here. It's acquisition and it's immediately current here. Okay. Then, sorry guys. So then we have at acquisition. Again, the same thing, the equities that we're used to, share capital and retained earnings. Also at this date. All right, so the share capital is not going to change. I can take it even from the trial balance. I want it in value. So my share capital for Violet, I'm now focusing on Violet, guys. My focus is now on Violet. The share capital is 100,000. So I'm going to go there and put 100,000. Then my return earnings on that date, I can get it from the trial balance because it's exactly the beginning of the year. It's exactly on this date. So Violet, it was 180,000. So I'm gonna come here and put 180,000. Okay, right. Let's see if there was any adjustment at that date. So from there, basically, so we dealt with number 3 already. Then number 4 talks about during the year. All right, so this is going to be during the year. It does not affect us at acquisition. This was also done. So it means that's the only thing that we actually have. Those are the only thing. There was no adjustments whatsoever on that. So we're going to find our total. So this is 280,000. So I'll take 280,000 multiplied by 49%. So I'm getting 137,200. Please just confirm the figures, ne? I want to be a little bit fast. Just be confirming the figures. Oh, thank you. So now I'm here. Then I need to compare this with the actual investment that I've put in this. So let me use a different color. So we want to start now investments. Investment in joint venture. Right, so I'm comparing this with the actual investments. Okay, so let's go back to the information given to check how much was the actual amount paid for this. So if I don't find this in additional information, I'll check it under the investment figure on the trial balance. Like here, we don't have it in number 3, so I'll check it on the trial balance under investments. Investment in violets, that's the one I'm looking for. Investment in violets at cost, it has to be at cost. So that will be 140. So we actually paid 140,000 for this investment. Right, so I'll come here and put in my 140. So guys, you can see again there's a goodwill, but this goodwill does not have an impact, ne? This goodwill is already part of the carrying amount. You do not include it as a goodwill amount, okay? On our statement of financial position, you do not include this. So we're saying 140,000 minus 1,370. 140,000 minus 137,200. This gives us 2,800. Like I said, you do not include this in your goodwill balance. Okay, it's only the goodwill from the subsidiary that you include. So that is actually where we actually get to start. So we're going to increase this 280 plus 2. Okay, so our starting point is going to be here. So this is the investment in joint venture. That will be my starting point. Right, then we now expand. Remember, we do not have in this particular scenario, we do not have the since acquisition period. We are going straight to the current year. This one takes us straight to the current year because of the timing that it was actually purchased. So I'm already in the current year. In the current year, what I'm most interested in is the profit, share of profits. Share of profit of joint venture. All right, so the good thing about this question is that they did give us the profit figure already. So we're gonna go there and check the profit. Profit for the year, there is 115,920. 115,920. That is, you see, this is what I was talking about. So here you have to share item by item. All right. It's not like your subsidiary where you can share the total. Here you have to share like one item by item because the accounting for it may differ. Okay. So on my share of profits, we only entitled to 49%. So unlike subsidiary, but subsidiary you actually take 100% of the figure. Here you don't. All right. You're only going to show that 49% in the total. So 115, 920 multiplied by 49%. So the only part that actually adds to my carrying amount will be that 49%. So in this case, it's 56, 8801. If rounded off, this is going to increase my investment in joint venture. Right. Then I'm going to look for intragroup transaction. I'm also going to look for dividends. Now, before I go to intragroup transaction, let me just skip that. Let me go to dividends because it's easy. Dividends is already given to us. Might as well do this before we actually take our time explaining the intragroup transactions. So, on the dividend, I'm going back to the trial balance. Dividends paid. Actually, we do not have. Violet did not declare or pay any dividends. So if we had, we're also going to share it and it was going to decrease the investment in joint venture. Yeah, I messed up. Hmm. I think it's back to normal, if I'm not mistaken. Guys, sorry, technology is being technology, ne? Okay. Fine, yeah. So we don't have any dividends. If I had any dividends, I was going to decrease here. This is what I was going to do. Right, so with that being done, let's go check out that intragroup transaction that was mentioned. Let's go check out the intragroup transaction that was mentioned. Yeah, I think we've been working, né? Everything is now very slow. Okay. Number 4 is what you're looking at. So during the current year, Mosaic Limited sold. Again, who sold? Guys, that one is very, very important. Whenever you do intragroup transaction, always ask the question, who sold? Especially under the equity method, especially under the equity method. It's very important to know who sold and who did, who bought, who's receiving the item and all that. So during the current year, Mosaic Limited sold inventory of 100,000 to Violet Limited at a profit of 25% on the cost price, very important, of the inventory. And on the 28th February 2017, Violet Limited had inventory on hand amounting to 50,000 that was purchased from Mosaic Limited. Guys, so as you will see, I will send you a video where I did intragroup transactions. So I just want to talk about it because of time. I'll just talk in passing. If this was a subsidiary, number one, because it is the parent that is selling, we were not going to include this in the analysis of owner's equity. Okay. Number two, for a subsidiary company, we eliminate the full sale for the year and also the unrealized profit on the closing balance. This is for a subsidiary. For a joint venture or associates, is different. Irregardless of whether it is the parent or the joint venture or associate that is selling, it does not necessarily mean it's not going to the analysis. Okay, so it will depend on a lot of things I'm about to show you now. That's number one. Number two, we do not account for sales. We do not eliminate the full sales like you do with subsidiary. You don't do that when it comes to joint venture or associates. It's only your only focus is on the unrealized profit. So you only eliminate unrealized profit and it's tax. You do not eliminate the sales during the year. Okay, so let me now show you how you're going to do this. So Violet and Mosaic sold to Violet. I need space. Let me work on this side. Okay, so we are saying Mosaic Limited sold to Violet Limited, right? So it means the investor is Moisek. Is blue. Moisek is the investor, and Violet is the joint venture. Okay, very important. So Moisek is the one making the profits, and Violet is receiving the inventory. Now, when you are dealing with equity method, we understand that we are going to have only one line item representing all my statement of financial position items, right? So I know that under equity method, okay, under my profit and loss, I'm going to have one line item, share of profit of joint venture. Under statement of financial position, I'm only going to have one line item, investments in joint venture. Right. So there won't be such thing as inventory. I'm not going to affect my inventory. Rather, this is going to affect investment in joint venture. Okay. Because the inventory is the one being affected here. So if I have to do a journal, I'm going to show you guys in the journal so that can make sense. If I have to do a journal, pro forma journal, which is a elimination journal. If I have to do the elimination journal, this is how I'm going to account for it. So on this side, it is the profit. For the parent, it's the profit that I'm eliminating from. And from the joint venture, it is the inventory, which is part of investment in joint venture. So what we do is we break this into sales and cost of sales. Guys, if you see me stopping, just know that something happened on the laptop, né? Either the pen or the laptop. So I have to wait for it to come back so I can continue my explanation. Okay, so this is gonna be broken. Sales and cost of sales. Okay, so they'll break it down like that to make up the profit. So this is how my journal is gonna be. I'm eliminating everything. So I'm gonna debit sales, profit and loss. I'm gonna credit cost of sales because it's an elimination. And I'm going to credit my investments in joint venture, not my inventory, because I don't show it as a one-line item. It's part of a group. All right. That goes to statement of financial position. These two goes to profit and loss. All right. So then we remember with joint venture and associate, it's only the unrealized profit we're interested in, not the sales during the year. So it's only the unrealized profit. So I'm gonna go up and get my figures again. So the amount is actually the closing balance is actually 50,000, not the 100,000. It's actually 50,000 that we closed with, and the profit is at 25% on cost price. 25% on cost price. So it means that I'm actually saying 50,000 times 25 over 125 because on cost price. If it was on selling price, it was going to be over 100. Okay, so that is basically what I am saying. But remember, this is not a subsidiary. You cannot take 100%. If it was a subsidiary, this would have just ended the calculation. But no, guys, you're not a subsidiary. You're only entitled to your percentage under a joint venture and associate. So your percentage is only 49%. That's your limit. That's your limit. Okay. Then, because we are breaking down everything, we break down even the sales. So the sales one is going to be, the sale is the 100% amount. So it's 50,000 and multiply by 49%, which is my limit. Cost of sales would be 50,000. Cost of sales would be the base. So it's the 100 over 125 times 49%. That's how you break it down, right? Guys, they love this journal. Like I say, because we're just trying to make sure we get you in there. I would have really loved to have more time to teach you guys groups, but unfortunately, we are really getting closer to the test. So we'll do as much as we can and still continue with groups. I know that after now, it's going to be groups. Yeah, it's going to be groups. After now, it's going to be groups and related parties. So I don't think there's other topics after now. Yeah, anyways. So we have here 50,000 times 49%. So I'm debiting 24,500. Then my cost of sales 50,000 times 100 divide by 125. This is 4 times 49%. This is 19,600. Then the last one, which is the one that we are more interested in, the part that affects investment in joint venture. So it's 50,000 times 25 divide times 25. I keep making mistake with this calculator. It's not my calculator. Times 25 over 125 times 49%. 4.9. Okay, so that's how you would have done that. And of course, you're going to have tax effect. So the tax is going to change. So my statement of financial position that is being credited will now be debited. And statement of financial position, that's where you find your deferred tax. Then the opposite will be income tax, profit and loss. So you take the profit amount, 4.9, already adjusted to that, multiply by 28% tax amount. So that would be 1372, 1372. Okay, that's how you would have done it in the journal. All right. That's how you would have done it in the journal. I'm going to look for a question like this where there's just journals. Maybe we can work on it. Because yeah, journals are also very important. I've seen that they love to test a lot of journals. Performer journal. Remember, this journal is not your normal. These are your like reversal journal, basically. They're elimination journals. So the life performer journals as well. We'll take our time also to do these. I'm going to find questions that has journals so we can work on them. Okay, so if you look at this actually does affect investment in joint venture because it's going to be credited by 4.9. All right, so I'm going to have that adjustment here. So we're going to say investment in joint investment in joint venture is where we are already. Sorry guys, this is unrealized profits. That's the description is unrealized profits and sale of inventory, unrealized profit on sale of inventory or on closing inventory. All right, so the final amount is actually 4.9. That's how much we're getting. This is decreasing this. So I want to calculate the 100% amount. This is actually the 49%. So if I take 4.9 divide by 49% to give me the 100%. So the 100% amount was actually 10,000. And then multiply by 49%, I get 4.9, and then that's how much I'm decreasing my investment in joint venture. Okay. So yeah, that's basically it. Those are the only items that are actually affected us. Now, if you look at the tax amount that we get here, oh guys, the laptop is very slow now. If you get the tax amount is 1,372. This is going to deferred tax and not investment in joint venture. This one actually goes to deferred tax. So we go to deferred tax and put 1,000 372. It's a debit, so I'm actually adding 1,372. So I'm going here under deferred tax. So I'm coming here, I'm adding plus 1,372. That's what I'm actually doing. That is coming from that investment in joint venture, that aspect. That's why I say let's not close, because there could still be things that will affect other accounts. At this point in time, guys, we are done because we have done everything that affects this column. Is what I'm interested in. This is the column of investment in joint venture. So I'm going to get the total of this column and then we're done. So 140,000 plus 56,801. You can see we are limiting this to 49%. Then minus 4,900. This is going to give me 191,901. 191,901. So that is my figure that I'm going to take. Let me just use this just as a reference. That's the figure that I will take in my statement of financial position. Statement of financial position. In here, that says investment in joint venture. There, that's where I'm gonna. This is already a final amount. I've already done all the calculation. So yeah. Okay. So if you look at that, guys, now everything has been touched. So guys, always tick off whatever it is that you have done already. Always tick off what was done. So I've dealt with 4 now as well. And if you look at everything has been ticked, everything has been ticked, everything has been ticked. So I'm done. Okay. Now what is left is just a total. Okay, guys, you can do that even yourself. It's not a problem. At this point in time, you're just going to total everything. So you're just going to come here, close the brackets, and then find your totals. So you close your brackets, find the totals in the brackets, close all your brackets, find the totals in the bracket. And yeah, once you find all the total, you also find the final total here. So guys, that is it. Guys. That is your groups. You can see, guys, like I said, groups is just a whole lot. But once mastered, once you understand it, guys, I'm telling you, you are going to perform very well. And please make sure you know groups, because groups is going to help you pass this module. It's going to help you do well in your final assessments. It's going to help you pass this. Even in the test that is coming up, it's going to help you pass the module. So please make sure you understand groups. I will send you, like I promised. First of all, I'm going to send the question we worked on now. Then I'm going to send you the other recorded pre-classes, like weight explaining principles and stuff, so that it helps you guys, to kick off very well. Okay, so yeah, that was it from me. I know it was a lot. It's 8 o'clock, an hour after the time we're supposed to finish. All right, thank you guys for your patience. This shows how serious you are with your studies, because I can see most of you stayed until the end. So thank you guys for your patience. And yeah, do you guys have any questions before we go? Any question? Okay, guys. Okay, I see a chat there. Thursday, guys. We are here again on Thursday. Okay, I will share. Guys, we are here again on Thursday. I test at 5 until it's gonna be 4 hours. Yes. On Thursday, I want to go back to the other topics. I want to do something that has employee benefits, something that has forex, something that has changing policy estimates, error, something like that, something around that. All the other units. Yeah, I want to do something along the other units on Thursday, and then we'll meet groups again on Saturday. Please, I'm also going to do another revision on YouTube, you are welcome to. In fact, you guys should join. How? What do I mean? You're welcome. You guys should join. You guys should share, and you guys should like. Because you guys are my students. You should be pushing my things. Anyways, besides, it's gonna be a different question, so it's still gonna be very, very helpful for you guys. The YouTube one is gonna be a different question from everything we're doing. Yeah, it's gonna be different from everything that we are doing. So it's more like another class. And please do join, and you can share that one. That is free for everybody, so you can share that with all the groups you are in, with everybody you know that is doing FAC. They are free to join that one, the YouTube one. Okay, anyways guys, catch you up. I'll send everything like I promised, and I'll see you guys on Thursday. Enjoy the rest of your evening, or should I say goodbye? Good night. Good night, guys.
Bye. Good night.
Good night.